Hey everyone, Steve here from 11ers, a channel where we talk about lucrative but sound investment strategies and opportunities based on the requests from the 11ers collective. Today we're going to talk about a recommendation by Dylan, one of our members, and it's going to be something different. It's a mini IPO. And I bet a lot of you have never even heard of that concept. But basically it's a way for a company to make their shares public without actually going public. The company is called Knightscope, and they do robotics. Full disclosure here, I have a soft spot for robotics. I loved RoboCop, iRobot, Wall-E, Terminator, that Japanese robot that plays the piano, the Japanese robot that plays the drum. So my opinion is a little biased, but I'm going to do my best to give you the pros and cons of this investment opportunity based on the business value and the market fit. If this is the type of content you've been looking for, please hit the like button and let's get started. So to give you a little bit of context, Knightscope does passive security robots. So essentially you can think about malls to parks, facilities like office buildings, where instead of hiring a security guard or having police presence, you can have one of these robots. It's got a shit ton of sensors built into it, along with its AI technology so that it can wander around like a Roomba, but does security instead. The first positive I want to talk about this business is its numbers add up really well if they can create adoption. So essentially they're offering robots as a service. It's a subscription-based service where you pay per hour for those robots. Based on the numbers they've provided, they're essentially expecting to make $50,000 per robot per year. And each robot has a 5 years lifespan. That's pretty good. $250,000 for 5 years per robot. The numbers also adds up for the other side, because you can imagine a security guard will cost you $20 or more per hour. This robot will cost you between $6 to $12 per hour. That's a huge savings. At the same time, you can basically reduce this unwarranted tension of having a security guard on site. And at the same time, a robot can be more objective in observing and quantifying crime because it's just a robot basing what it sees on algorithm. It can also see a lot more because it's a robot. It's got eyes like spiders. The second reason why I like Knightscope is that they're leveraging a land and expand business strategy. The idea here is that you identify key markets that you're interested in. Then you basically find a partner that's willing to work with you either at cost or at loss. But the idea here is that you're building a proof of concept. You have a set of key metrics of like reducing cost, reducing crime, etc. You prove that it works. And then once you've proven that it works in this business vertical, then you find other businesses in the same industry, same vertical, and say, look, it's proven that it works. This is why you should buy our service as well. This has gotten them into hospitals, malls like Westfield, into sports arenas, into even military-related applications. These are all really great signs for the fact that they're taking this landing approach and the landing bit is working out. Now they need to expand further. One thing to note also is that in order for them to play in the hospital space and the military space and police departments, they've most likely passed compliance certifications, which is a huge roadblock for a lot of companies to go into in the first place. So this gives them an opportunity to be first to market, and also, as long as they prove efficacy, then they have a huge growth potential here. The third reason why this company might be a good investment right now is the political climate that we're in, especially in the United States, where everyone is advocating, where a lot of people is advocating to reduce, police presence, reduce their budget. This might be a really reasonable compromise. This is kind of like the body cam play. The rationale here is that governments are very much not inclined to cut budgets, because if they reduce the police budget and the crime goes up, they're still going to get blamed. But if they go towards a future technology, leveraging something that's passive security, then it might be a really good win for both sides of the party. This way you don't have outlier cops raging out in public, and also you reduce the unwarranted tension of having security and cops in places where they're not particularly fond of. If this interests you and you haven't done so already, I highly urge that you check out the interviews done with the Knightscope CEO. The guy is very charismatic, very well spoken, and the numbers that he speaks with, he clearly believes in the project. He's very passionate about this idea. And when you're investing in a startup, that's half the battle. The biggest challenge is what is their top line and how fast are they growing? Especially because this is a private company, there is a lot less transparency. It is interesting that on their site, they're hosting an analyst report that basically says in 2018, they're making $3 million in revenue. And that's how they got to a $300 million evaluation at $8 a share. Beside the fact that I don't think $3 million in revenue justifies $300 million in valuation, those numbers are from 2018. I'm questioning what their growth was in 2019. And even if they had a 5x growth in 2019, that's a great sign for growth, but still the top line is very, very low. The second risk I want to highlight is the fact that this company, if you invest in it, it's going to be very, very illiquid until they go public. The only way you can sell your shares is essentially in a secondary market because it's not on NASDAQ, which means that you're going to tie up your money for however amount of time. Now, the amount of time is the third risk that I want to highlight. It took me quite a bit of time to research, all of the nuances of a mini IPO, and there was only one slide that highlighted this specific detail that I'm not 100% if it's right or not, but I think it's worth highlighting here so that you can correct me if I'm wrong. And it says, if the company blah 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 has a public float of more than 75 million or annual revenue greater than $50 million, the company will enter a 2-year transition period to begin complying with the reporting requirements of fully public companies. Please do correct me if I'm wrong, but based on what I just read, if this is accurate, once this round is over, there's going to be 2 years before this company goes public. You have to really believe in this idea and think that it will make you a ton of money in order for you to tie up your money like that. So all in all, I think this company offers a very interesting value proposition. And market fit, I think is there. But in terms of timing, that's very speculative. It can happen. It's more likely to happen right now. But that doesn't mean that it will happen right now. Even successful VCs have a hit rate of 30%. If they can have 30% of their companies to pay out, then they are a successful VC. So if you want to invest in this company, I highly encourage you to think about it the same way, in the sense that there is 70% chance that you will lose your money. And also, you have to think about the fact that your money will be tied up in this company. So the amount of money you want to invest should be limited as well. Alright guys, I hope you found this summary useful. If you have any questions or concerns or other requests, please leave a comment. And if you haven't done so already, please hit the like and subscribe button. Thanks for watching, and I look forward to working with you next time. Thank you.